Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 2nd May 2025, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Head of UK, Ireland and Swiss Corporate Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Derek. Great to see you as we head into the long weekend in the UK.
Indeed, and you. That's a good one.
Yeah, another busy week and a hot one here.
Yeah.
I guess let's start with the sort of imminent news, what we've had today. Non-farm payrolls in the US. Headline figure higher than the market was expecting, but as always, the devil's in the detail on these things. So what are your thoughts on the breakdowns of the data in the US today?
Look, the markets, obviously, there's a good logic to thinking we're heading for weaker hard data, given the sentiment readings, given the uncertainty related to Trump's policies. So I think certainly if we'd got a big weak figure today, I think the markets could really have moved and aggressively priced in recession. But that didn't happen, obviously. 177,000 is a pickup relative to the consensus, which was 138. It is down from last month. We had a revision of 58,000 over the last 2 months. Interestingly, government jobs did not show declines. We had a 10,000 increase in April, 15 the previous month in March. So DOGE, in terms of that impact, not there as of now. That other data that I spoke about, the Challenger survey, consumer confidence, expecting fewer jobs going forward, ISM, services employment dropping sharply. ADP was slow this week, although that doesn't statistically mean much in terms of this print. But there was plenty of evidence to suggest that the labour market could be weakening. So, obviously we've pulled back in terms of recession risks, and that has implications in terms of rates, with rates up about 6-7 basis points and equity markets higher. The interesting aspect, I guess, is the fact that the dollar is weaker across the board. So have we flipped back to your textbook risk on, risk off behavior for the dollar, where risk on is dollar negative? Possibly.
Do you think that reflects an easing in sentiment over tariffs?
Yes. Again, you could argue a couple of weeks ago, even just over a week ago, you would argue that easing tariff concerns was helping the dollar, because obviously we had sold off sharply on the back of the reciprocal tariff. So I guess in conclusion, the market's a little bit all over the place, certainly from an FX perspective. You could throw in dollar yen as well, which is down sharply today. I think maybe just the easing of risk tensions has helped Asia FX for sure, like dollar Taiwan. Wouldn't have expected, but it was down 3.5%. Some big moves in Asia, which I think reverberates into the broader market, certainly for Aussie and Kiwi, which are up over 1% today. A little bit less in core G10. So I think, just the China statement that we had this morning for us when we came in to London, that signal from the Commerce Department in China that they are evaluating talks with the US after the US had reached out to China. So there was that news. There was also news from Europe, Sefcovic, the trade commissioner, saying that they were proposing a deal of buying 50 billion additional imports from the US, and certain progress was being made in talks. And then we've had this comment from Stephen Mirren saying that he envisages in the next few weeks tariff rates coming down. So, I think the general risk, the improvements, and the receding concerns is helping to lift non-dollar currencies. Yeah. Started in Asia and I guess reverberated out further from there. So yeah, I guess that's the momentum into the weekend, and we'll obviously see what developments take place.
Where do you think it leaves us for the FOMC meeting in June? There's quite a lot of focus on that. I think the last I looked, the sort of market pricing was around 50-50 for a cut there.
Yeah, it's about 10 basis points now. So,
okay.
The 2-year yields are up about 6 basis points as we speak. So, yeah, a pullback in terms of the prospects of a cut at that meeting. So I think it puts Powell in a more difficult position next week, because he certainly can't be more confident about signaling the potential for a rate cut, given the uncertainties in relation to inflation and now the signs that the labour market continues to be resilient in the US. So, of course, that brings back the prospect of more comments from Trump and, Powell's a loser again, and everything we get on that. So that tension could rebuild next week. But from Powell, in terms of guidance, I would imagine he may take a leaf out of other central banks' books, which is basically not giving that much guidance. And just saying we're in a high level of uncertainty and we'll assess things meeting by meeting. It's going to be difficult for him to signal a willingness to cut on the back of this report.
And I guess looking forward to next week as well, aside from Powell, is there anything else we should be looking for or focusing on?
Yeah, well, next week, apart from the Fed, we've got the Bank of England, and again, a rate cut is fully priced, so I think we'll certainly get that. 25 basis points is more likely. There is still some stickiness in terms of wages, which has made us a little bit cautious about arguing that the Bank of England can go more aggressively. But demand for labour is definitely coming down. The PAYE employment print was much weaker. And, when you listen to Bailey in Washington, there was a focus on the demand shock rather than the supply shock. That was the more important element. So I think that was the signal that the Bank of England are more concerned about the demand side. So in that sense, if things were to worsen, you could argue that maybe the Bank of England could accelerate the pace of cuts later in the year. I'm not sure we're going to get that kind of guidance from the bank next week, but they may just keep the messaging the same to ensure the pricing remains roughly the same, which is roughly a cut per quarter. It's keeping that steady pace, which I think is probably most likely. So I think from a sterling perspective, there wouldn't be a huge amount in that. And yeah, like I mentioned earlier, dollar yen is the if it's risk off, or sorry, if it's risk on, dollar weaker, you would imagine the yen would have been weaker as well. So dollar yen would have held up more as the dollar was weakening. But dollar yen has reversed most of yesterday's gain. I think the logic behind that is maybe yesterday was overdone. As we've highlighted in our research this week, we've gone from a record short yen position when you combine institutional investors and leveraged funds positioning. So there was a record short as of July of last year, and we swung around to a record long. And that's in data going back to 2006. So the record long is an indication of the high level of conviction that dollar yen is going to fall further from here. So the shift from the BOJ yesterday being a little bit more dovish, that prompted clearly a liquidation of some of those long yen positions. And I just think today maybe, investors think that's gone too far, and the broader dollar weakness that I mentioned in Asia, and that's just pulling dollar yen back down. So net, we're still a bit higher than where we were before the BOJ meeting, but we've retraced much of the move today.
Thank you very much. Well, enjoy your long weekend, and catch up with you next week.
And you, Simon. Thanks.
Thank you for listening to this MUFG Global Markets FX Week Ahead podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.